If you're an Indian retail investor, does this feel familiar? You're doing everything right, you're putting your money in, but when you look at your portfolio, it feels like it's just stuck on a treadmill. You're putting in the effort, but you're not actually going anywhere. Let's break down why that is and what it really means.
Okay, think back to the start of 2024. Remember that optimism in the air? You had your plan all laid out, you put your funds to work, and you were ready for the market to reward you. You did everything by the book.
Here we are. And months have gone by, you log in to check your portfolio, and it's like you're staring at a photograph of where you started. That feeling of running in place, it is not just a feeling. The numbers actually prove it.
Let's put some hard numbers to this feeling of being stuck. Just how stagnant has it been? Let's take a quick look at the data.
We use the Nifty 50 as our benchmark here. At the beginning of the year, it was sitting right around that 26,000 mark. For a lot of us, that was the starting line for our 2024 investment journey. And today, well, would you look at that? It's still right there. The number hasn't changed. All that time, all the news, all the ups and downs and volatility, and we've basically gone nowhere. We've ended up exactly where we started.
This kind of sideways movement, it doesn't just happen in a vacuum. It makes people nervous, right? It creates a lot of uncertainty. So what are other people doing? Well, it turns out a lot of them are getting out.
And this is where market psychology really kicks into high gear. While a lot of investors are holding on, lakhs of others have seen this flatline, they felt that anxiety build, and they've pulled their money out. And when you see other people running for the exits, it makes you ask yourself a very important question.
That mass withdrawal forces every single investor who's left to wonder, am I in a sinking ship, or is this just some rough weather that'll pass? This leads to two completely different ways of looking at the exact same situation.
The first way of thinking is driven by one thing: fear. You see people leaving, you see zero growth in your own account, and you can't help but wonder, is this it? Is the great Indian growth story finally over? Is it time to just cut my losses and get out
There's
now?
the other side of that coin, the voice of patience. The one that asks, wait a minute, what if this isn't an ending? What if it's just a phase? A completely normal, even healthy pause before the next big run-up.
And this slide really lays out that internal debate perfectly. On the left, you've got the market over camp. They think this is the new reality and it's time to exit. But on the right, you've got the just a cycle camp. They're saying, hey, markets do this. These quiet periods are not only normal, they're necessary for future growth.
So here you are, the individual investor, caught right in the middle of this huge tug of war between two powerful stories. And that brings us to the real question you should be asking yourself.
Maybe we're all focusing on the wrong thing. Trying to guess where the market is going next is, well, it's a guessing game. The most important question right now isn't actually about the market at all. It's about you.
So this is what it all comes down to. This is the real takeaway. When you look at your portfolio today, are you seeing a test of your patience? Or are you feeling that pull of panic? Is your next move going to be guided by your long-term plan, or is it going to be a reaction to all this short-term noise? The market will do what it will do, but your answer to that question, that is what will truly define your success as an investor. Sure, you've seen the headlines, right? Gold is absolutely soaring. But whenever an asset gets this hot, you've got to ask yourself a really important question. Are we looking at a golden opportunity here, or is it a trap? Today we're going to dig into this gold rush dilemma by starting with a classic, timeless market principle.
This one before.
You've maybe even from your parents or grandparents. When the market falls, gold shines. It's such a simple but powerful idea. Basically, when financial storms start brewing, what do investors do? They run for cover. And for, well, centuries, that cover has been gold. It's not really about getting rich quick with gold. It's more about preserving what you have when everything else feels like it's falling apart. You can almost think of it as the ultimate financial insurance policy.
Okay, so that's the theory, the old wisdom. But what's really interesting is that right now, we're seeing this play out in real time and on a massive scale. So let's talk about what's been happening, the recent gold rush.
Think about the last year and a half. It's been a total roller coaster, hasn't it? We've had inflation spiking, all these whispers about a recession, global conflicts. It's just been a cocktail of anxiety for the markets. And when things get this uncertain, investors, they don't just walk, they run to what they see as a safe harbor.
In this rush, something pretty new actually. Gold ETFs, exchange-traded funds. Think of them like this. They're funds that trade just like stocks, which makes it incredibly easy for everyday investors like you and me to get into gold without, having to buy and store actual physical gold bars. And the result of this? It's been a tidal wave of money pouring in, a real modern-day gold rush, and it's being driven by one of the most powerful forces out there, the fear of missing out.
But here's the thing about a stampede, right? They don't always end well for everyone involved. And that brings us to a really, really important question. Is this massive crowd chasing a huge opportunity, or are they all just sprinting towards a cliff? This right here is the heart of the whole dilemma.
Because after all that initial excitement, that's when the doubt starts to creep in. Yeah, the headlines are all screaming, buy gold, buy gold. But you know what? Seasoned market watchers, they know that when everyone is shouting the same thing, that's usually the time you need to stop and start asking some really tough questions.
And this brings us to a classic market pattern. You've got the big institutional investors, what people call the smart money. They tend to buy when things are quiet, when nobody's really paying attention. They get in early. But by the time an asset is plastered all over the news, and even your neighbor is telling you to buy it, well, that's often when the smart money is quietly heading for the exits. So here's the billion-dollar question. Is this huge flood of new investors a sign of strength, or is it actually a sign that the party's just about over?
You know, it feels like we've seen this movie before, right? Think about it. The dot-com bubble, the 2008 housing crisis. The details are always a little different, but the script, it often feels exactly the same. First, there's a huge surge of public excitement. Everyone gets that feeling that, oh, this time it's different. And then, well, then comes the painful lesson in market psychology.
So here we are. We're at a crossroads. Is there still time to jump in on this gold rush? Or are the people who are just showing up now simply funding the exit for those who got in early? The numbers, they look really compelling. But history is kind of whispering a warning in our ear. And that leaves us with the one question that really truly matters right now. Is history about to repeat itself?